So a few days ago, the largest IPO in the history of humanity took place.
The company begins trading today on NASDAQ under the ticker SPCX in what stands as the largest public offering in the history of capital markets.
SpaceX went public at a valuation of over 1.75 trillion US dollars. And to think about this is absolutely insane, but here's the part that should make you pause. Musk is reportedly giving about 30% of shares to regular retail investors, people like you and I. That's 3 times higher than any normal IPO that we have ever seen in the history of humanity. But hold up for a second, the most valuable private company that has ever existed suddenly wants your money specifically. Well, I believe there's a reason for that, and we're going to get to that in a couple of minutes. But buried inside all of this is a 1.25 trillion merger that almost nobody is talking about.
XAI is kind of a failure. So now he's got this huge infrastructure which he rents to other people because that's the only way he can recoup the cost.
Well, in this video we are going to be looking at what's actually happening here, because once you see it, you're going to understand why this IPO isn't really about rockets at all. Hi, I'm Clinton Kingsley, and if you've heard about the SpaceX IPO, you've probably heard about the rockets, but what you probably haven't heard about is the $1 trillion deal hiding behind all of it. And to get started, we have to look at what SpaceX actually does, because the public story is genuinely impressive. So SpaceX operates a company called Starlink, the world's largest satellite internet network, with over 9,800 satellites in orbit and more than 10 million subscribers. In 2025, the company generated about $18.5 billion in total revenue, and Starlink alone made about $11.4 billion of that, which is 61% of everything that SpaceX earns. And it's the only part of SpaceX that consistently prints green on its balance sheet. So far, this sounds like a great company to invest in, right? Real revenue, real profits, and real growth. But here's where things get complicated. In February 2026, something happened that should have been on the front page of every single news outlet out there, but most people missed out on this very important detail. Elon Musk merged XAI, his artificial intelligence company, into SpaceX, and the combined entity was valued at about 1.25 trillion US dollars. And XAI itself was valued at about roughly $80 billion in that deal. Now, on the surface, the official reasoning makes perfect sense. SpaceX needs the AI infrastructures for things like autonomous systems and Starlink optimization, and XAI needs the computing power and data centers. But here's the detail that changed the entire picture. XAI was burning a lot of cash, and I mean heavily. SpaceX itself posted a net loss of nearly $5 billion US dollars in 2025, and that loss is largely attributed to absorbing XAI's cost. Let that sink in. SpaceX, the rocket company with a profitable satellite business, took an almost $5 billion in losses the same year it merged with an AI company that needed to stop burning cash as a standalone entity. In translation, XAI was running out of money. And instead of raising more private funding for an AI company in an increasingly crowded and skeptical AI market, Musk folded it into SpaceX. And why does that matter? Because now, when SpaceX goes public, XAI goes public with it. And wrapped inside the brand of rocket, Mars, and the future of humanity is an AI business that needed a way out from its cash problem. And public market investors are about to fund XAI losses. They don't just know what they are doing because it's labeled as SpaceX, and by public markets I mean you and I. Now let's talk about the second piece of this, because SpaceX's relationship with the US government is something that we have to shed light upon. So SpaceX space segment, the part that launches the rocket, generated about 4.1 billion US dollars in 2025, and most of that came from the Pentagon and NASA contracts. But the number that should make you think, SpaceX completed about 165 Falcon 9 launches in 2025, and only 43 of those were outside customers. Nearly 3/4 of all launches were internal, meaning SpaceX was essentially launching satellite for itself. So when you hear SpaceX dominate the launch market, what it actually means is SpaceX dominates a market where SpaceX is almost the biggest customer. Now, layer on the government relationship, NASA and the Pentagon. These aren't just customers. They are the foundation for SpaceX legitimacy and a huge part for the valuation case. Which means that SpaceX's future is directly tied to staying in the good graces of the contracts political relationships and regulatory approval from the government. That's not criticism. That's just the structure. But it's a risk that almost never gets mentioned in the room of all the excitement. And here's the number that actually matters more than any of the headlines about Mars. SpaceX is being valued at 96 times the trailing revenue. And for comparison, even at the peak of the dot-com bubble, most expensive tech companies traded at about 20 to 40 times revenue. SpaceX is at 96. And what does a valuation like that actually require? It requires a near perfect execution for years with no major missteps. 96 times revenue means that investors aren't paying for what the company does today. They are paying for a vision of what the company might become in the next coming decades. And there's a crack already showing up in that vision. SpaceX average revenue per user, how much each subscriber pays per month, fell by 18% from about $99 to $81, even as the subscriber base quadrupled. In May 2026, SpaceX reversed that trend and raised the prices by up to $10 a month. Why? Because the growth at any cost phase has a limit. And at some point, the company needs each customer to actually be profitable and not just numerous. And this is the same pattern that we have seen in certain companies before, likes of Uber and WeWork. Companies that look unstoppable on the growth chart until the market asks the most important question. But is this actually making money per customer? Well, SpaceX is at that inflection point right now. And right now, it's asking the public to buy in at an evaluation of 96 times, which is completely insane. Now we get to the question from the beginning. Why is Musk reportedly setting aside up to 30% of shares for retail investors, 3 times the normal amount that we have ever seen? Well, there are 2 ways to read this. And the optimistic read is, Musk wants to democratize access to space investing. Let regular people, the ones who follow SpaceX from Falcon 1's first launch to Starship, own a piece of this dream. And the skeptical read is, retail investors are typically less price sensitive and more emotionally attached to a brand than institutional investors. What do I mean? Institutions run models. They look at the 96 times revenue and they ask hard questions. Retail investors, on the other hand, who has watched rocket launching on YouTube for decades, are more likely to buy because they believe in the dream. Well, both reads can be true at the same time, and it can be genuinely exciting for regular people to own a piece of this, and also be a smart move for ensuring the IPO isn't well received by buyers who are less likely to ask, wait, what about XAI losses? So here's what's actually happening when you connect all 4 pieces together. SpaceX has one genuinely excellent, profitable business, which is Starlink. And it has one massive, well-connected but internally dependent business, largely funded by and serving the US government. And in the midst of all of this, it just absorbed a cash-burning AI company, XAI, that needed a financial life raft. And that absorption is now baked into XAI's financials. And all of this is asking the public to fund all of this at a valuation of 96 times revenue, 3 times higher than even the most expensive tech valuation in the past. Well, none of this means SpaceX is a bad company. Starlink alone, as a standalone business, would probably be a compelling IPO on its own merits. But SpaceX IPO and Starlink IPO are not the same thing. And the gap between these 2 things, which are the government dependency, the XAI merger, and the eye-watering valuation, is where the real risk lives. And here's how I'm thinking about this personally. I'm not saying don't participate. Companies like this don't come to the market often, and being part of something historical has its own value beyond pure financial returns. But I think it's important to separate the story from the financials. The story is rockets, Mars, the future of humanity, and this story is genuinely inspiring and compelling. But the financials are a company posting nearly $5 billion in losses and absorbing an AI business that needed saving, dependent on government contract, priced at a valuation that leaves almost no room for anything to go wrong. If you participate with your eyes open, know exactly what you're getting into, and know that what you're buying isn't rockets. It's an AI bet wrapped inside a rocket. And in the next couple of weeks, the SpaceX IPO is going to dominate the headlines for weeks, and you're going to hear about Mars and the future of humanity. But what you are going to hear less is about the $5 billion loss that the XAI measure brought, and also the 96 times revenue price tag. But well, now you know both sides. And as always, please do your own research, and I am not your financial advisor. I just think it's important for you to understand what you're actually getting yourself into. Well, if you found this helpful, smash the subscribe button, give a thumbs up, and I see you next week. Bye bye.